Ranko Browning, president of the Utah Petroleum Association. Thank you so much for joining us. We're excited to talk with our colleagues at Ryan today, and specifically Andrew Becerra, who is joining us to share his expertise on tax policy from DC to the West and how it shapes the field. Andrew's going to cover a broad swath of issues, but it's definitely a timely topic as we are engaging regularly with members of the Utah legislature here. They're contemplating some significant tax changes. So tax is top of mind for us here at the Utah Petroleum Association. Ryan is also sponsoring our Lunch and Learn today, so big thanks to them for supporting our Lunch and Learn and our industry more generally. Just before we hop into that conversation, I want to start with a couple of announcements and some housekeeping before we get started. We are already at the end of the year, so I can't believe I'm saying this, but our last Lunch and Learn will be next month, where we are going to be joined by the Utah Safety Council to talk about safety essentials and the triple win of safety. We're going to hear more about how safety culture and practices not only mitigate against accidents and loss of life, but also the financial case for investing into safety. And again, that'll be our last Lunch and Learn of the year. We'll be hosting that on November 18th, a week earlier than usual. So go ahead and mark your calendar so that we are not interfering with everybody's well-deserved Thanksgiving breaks. And then we will reconvene this Lunch and Learn series after the Christmas holiday and the conclusion of Utah's legislative session in March. So next month will be our last month until we see you all again in March. And then again, we're coming up on our last event of the year as well. So our Young Professionals Networking Lunch is going to be coming up on December 4th in Salt Lake City. We are extremely appreciative of Savage, who's going to be sponsoring that. And you can head to our website for more details and to register for the event there. But December 4th in Salt Lake for our last Young Professionals Networking Lunch of the year. And then I also wanted to remind you to save the date for our annual meeting. We're already getting excited here in Utah for ski season. We've got some snow on the tops of the mountains. So our annual meeting is going to take place again at the beautiful Sundance Resort. It will be on March 16th and 17th. So we'll have some hopefully good spring skiing for you on the 16th with some meetings and discussions and guest speakers peppered in throughout the day, and then 17th full day of meetings. New to our programming looking forward, not in 2026, but in 2027, we're going to be hosting a joint regional conference together with our colleagues from the Petroleum Alliance of Wyoming and the Colorado Oil and Gas Association in Denver. So this year in Sundance and 2026 will be our last year to enjoy Sundance until we rotate back there in 2028. So head to our website. We'll have the room block up potentially later today, but within this week. So mark your calendars for March 16th and 17th. And then just a quick final reminder, you should already have an email if you go back to August 1st, should you want to search for it, from Eden Newell, where we've asked you to please let us know your plans for renewing with UPA. Let us know what membership level you want to join us at. And if you would like to already register for your 2026 events and any sponsorships of those events, you can do that all in one go. Send us back what your kind of menu of selections for next year looks like, and we'll send you back a single invoice, trying to keep it easy for you. Of course, you can always change your plans throughout the year. We will open registration for all of our events, including for golf, which I know we're already starting to get calls about, in January of 2026, and you'll be able to register for all of our events and find details for our entire event schedule and lineup of 2026 in the calendar starting early January. So with that, Let's get into today's discussion. Just a reminder that we are happy to take questions as we work through the discussion today. You don't need to wait until the end. Just drop a note in the YouTube chat on the right-hand side of your screen. We'll keep an eye on those and interject the questions into our discussion today. And so I'm going to turn it over to John Ekstrom, who our regulars know as our communications lead and our fantastic moderator. John, time's yours to introduce our guest and our generous sponsor today, so please take it away.
Ricky, a pleasure as always. And even though I cannot see you out there, I'm sure you're all looking beautiful today on this late October Tuesday. Joining me today is Andrew Becerra. He is Director of Advocacy Services at Ryan, LLC. We are going to talk about how federal and state policies shape the field from Washington to the West. We'll cover the latest updates from Washington, including DOI actions, One Big Beautiful Bill, Utah's tax incentives, and other competitive comparison with other major players in oil and gas. Andrew, we are happy to have you here, and the floor is yours. Looking forward to hearing from you. And as Ricky said, please drop your questions in the chat. I'll be happy to convey them to Andrew, and we've got lots and lots of good stuff. So without further ado, Andrew, the floor is yours.
Thanks, John. Well, first I want to thank you guys for hosting me today. Utah has always been a special place and has been a special place in my heart for a couple of reasons. And I must admit candidly that I wish I was sitting there in Salt Lake City with you having lunch rather than here in Houston where it is still 86 degrees outside. So I do miss Utah's wonderful weather. But again, as John said, I'm Andrew Becerra. I'm a Director of Advocacy Services at Ryan LLC, and I also currently serve as the Chair of the Tax Committee for the Independent Petroleum Association of America, which again is a great group of individuals out there that advocate on behalf of smaller producers in DC to ensure that you guys are able to continue operating. But by way of background, quickly, I worked for 6 years with the House Committee on Natural Resources. I started out as oversight counsel there and eventually advanced to the staff director for the subcommittee on energy and mineral resources, all while they're being chaired by the great chairman Rob Bishop from Utah. So it's always, again, Utah has that special place, but when I was there at the committee, I oversaw the development of legislation associated with oil and gas development on federal land and waters. And so this is something that is near and dear to my heart. And while tax is something that I do now, I still like to think that I'm extremely passionate about this industry and want to see it do well for the future generations. Since my time at Ryan, I started out as an assistant general counsel for our severance tax practice. So I would assist with, various counsel-related duties that were oil and gas related in nature, but it did give me a time to connect with that. And then I obviously transitioned into this role as director, where I'm now in charge of our federal affairs. But quickly, I do want to give a bit of an introduction as to who Ryan LLC is, because every time I have a meeting with department officials, government officials, NDC, or just members of Congress, the first question I ask is, do you know what we do? And everyone just gives us a very blank stare at the end of the day. So unless you're a comptroller in a tax department, you probably don't know who we are. But we're a global tax consulting firm. We have over 7,000 employees. We work in about 70 countries, and we have jurisdictional matters in essentially every state in America. We handle everything from local property taxes, state sales and use taxes, and all the way up to the federal issues, right? So we handle federal royalty calculations. We develop and manage the investment and tax production credits. We transfer those between clients. We even do work on historic tax credits. So if it has tax in its name, if it's a fee issue, we probably address it one way or the other. But again, for this audience and for oil and gas, like I said, we calculate severance taxes that are owed to the states. We look at the sales and use taxes that are assessed for equipment used in the oil and gas processes. And again, rather uniquely, we work to help calculate federal royalties for the production of oil and gas on federal land and waters. Obviously, we have a wide purview, and we've achieved this success because of the tax positions that we've taken and the tax professionals that we have. Now, I'm going to direct you to the top where it's essentially our whatever it is, our motto. I'm not going to read that, but really at the end of the day, what we do at Ryan is making sure our clients pay the exact amount of taxes owed, not a penny more or a penny less. And we also seek efficiency in the system. And I think this is rather unique. We want to make sure that the tax system works both for our taxpayer clients, but also for the people that are in charge of collecting it. So we frequently work with the tax collecting authorities to identify inefficiencies and improve those for everyone across the board. Now, finally, before I get into the meat of this, I am going to give a couple of disclaimers. First, I am a recovering attorney, as I mentioned, and I'm not an accountant. Excel gives me allergies. I am confused by it. And as you can tell from this slide and future slides, I have not advanced much beyond a high school understanding of PowerPoint. So I apologize for both of those. But I'm happy to answer questions about policy. I might be able to answer some questions about calculations. But if I'm not able to do that, I definitely will know a guy or gal who can provide more substantive answers. So with that, I always like to start with the kind of a high level review of where we are, right? So federal lands and waters are going to continue to play a significant role in American energy production. And I say that because Utah being a Western state, you have a ton of federal land and a lot of your production comes from this. But at a glance, quickly, it's 26% of U.S. oil production comes from federal lands and waters. Onshore represents about 13% of oil, 11% of gas. And what this translates into for states like Utah is the return of federal royalties, right? So in 2024, the production on federal lands saw a return of $187 million generated and returned back to the state of Utah for oil and gas activities on the federal land. And at the end of the day, about 20% of oil produced in the Mountain West is generated there in Utah. So let's dive right into the fun federal stuff. So, One Big Beautiful Bill Act. I hate that name. And so I'm going to refer to this as OB3 going forward. And even though that sounds kind of like the Star Wars character C3PO, it's better than saying Big Beautiful Bill Act. I know what a bill is. I know what an act is. I do not know what a bill act is. But to really set the stage here, this was a pure partisan bill. It was passed by the Republicans in the House, passed by the Republicans in the Senate. And why I don't want to get into too many weeds, it's important to understand that this was done through a process known as budget reconciliation. Not getting into the nuances, but when people talked about, oh, well, we'll be able to get permitting reform, other things done on this act, it wasn't achievable because one of the biggest hangups with this is everything has to have a financial impact and it has to have a primary budgetary purpose. It can't be policy based. So this wasn't our opportunity to do permitting reform. This wasn't our opportunity to refine what NEPA is, et cetera. But there were still some good changes in here. And I think really oil and gas ended up on the positive side at the end of the day. So with that, I think, with my position as the IPAA tax chair, I really liked how they approached Congress and how to essentially define what they wanted to achieve, right? It was two principles. One, do no harm, and then two, to advance pro-energy dominance legislation. And the do no harm is something that I think a lot of people miss, right? It's what are we doing right now that we can't afford to lose? And I'm going to quickly cover these three items because these are very valuable items that were valuable to our the IPAA membership, to our clients, et cetera. And without these, it really would cast a doubt on the future of American production. So first, percentage depletion. Now, what this is, it's a small producer issue, but the small producers are critical because at the end of the day, these marginal wells make up about 7% of our domestic oil production. But it's just a very minor issue it's a major issue for our minor producers, I guess is the best way to put it. And not getting into all of the calculations and whatnot, but if this were to go away, we would have lost potentially 7% of our production. And this is very valuable for the mom and pop producers out there that have 12 or fewer members. Intangible drilling costs, however, is a substantial issue for oil and gas operators across the country. And the standard IDC tax deduction has been around in one form or another for about 100 years. It allows producers to recover expenses an operator may incur at the well site. For instance, these could be labor costs, they could be site preparation, renting drilling rigs, etc. So normal business expenses that if you were a baker, you would be able to deduct your labor. We just have, for some unknown reason, a very complicated name. And so when we have to explain this to Congress, it's a very difficult task that we have to balance and be like, no, this is just regular billing costs with a very strange name. But without this, if this were to have gone away, if this is something that is, under constant threat, it would strip away roughly 25% of the capital that's available for producers to continue looking for new oil and gas opportunities. So highly critical item out there. The final thing is the passive loss exception, which enables working interest owners in oil and natural gas production to achieve a little bit of parity between their investments and those of corporate shareholders. By counting any working interest investment losses as active instead of passive, they're able to treat their normal business deductions from their investment in the same way that a corporation would. So those were kind of the three focuses that I sat in as the tax chair. Obviously, Ryan had other, critical priorities, but for the purposes of this audience, I wanted to just cast a wide net and say this is what industry associations were interested in. So how did we do? Well, let's see. The actual results: no harm was done. Hooray, we succeeded. That was a big win. And again, it's critical, and why I provided a little bit of education there, because there's not always going to be friendly oil and gas administrations. There's not always going to be an oil and gas friendly Congress. And continuing to inform and educate members on both sides of the aisle as to what these items do is going to be very, very crucial going forward into future Congresses and future administrations. But specifically, there were a few updates, I think is the best way to put it, for a couple of those items. One, the IDC fix for corporate alternative minimum tax. And the CAMT was something that was brought about in 2022 by the wonderful Inflation Reduction Act, the IRA, or as it's sometimes referred to as the Green New Deal bill. But what the CAMT did was it established a 15% minimum tax on corporation whose adjusted financial statement exceeded $1 billion. Under the IRA, IDC costs were not factored against this. And so a lot of companies were concerned that they would be subject to this corporate alternative minimum tax. The OB3 fixed this and said, no, you can include the IDC cost when you are looking at your adjusted financial statement. And so it reduces potential exposure for a lot of producers to the 15% minimum tax. The other thing that was a big update is the 45Q credit. Now, what this is, it's been around since 2008. It allows for companies to obtain a tax credit that for the sequestration of carbon dioxide in certain ways. Now, historically, they favored certain types of sequestration over others. One of those others that was on the disfavored list was enhanced oil recovery. OB3 changed this, however, and they increased the value of the credit for enhanced oil recovery by $25 per ton. And so this allows parity, and I think it makes it much more economically viable, EOR that is, for companies as an alternative to simple sequestration who are trying to achieve and get this credit. One other, oil and gas specific thing, and this again goes back to that passive working interest. Under the Tax Cut and Jobs Act of 2017, I believe it was, the Section 199A really allowed for that passive working interest to be adopted and to be considered. So it would allow eligible pass-through entities to deduct up to 20% of their qualified business income. And again, here, this maintains that working interest and defines it as an active entity, and so therefore they're allowed to continue deducting that, and it made it permanent. Another thing that it did was for the bonus depreciation, it made this permanent. Now, I'm going to caveat that a little bit, and I'll get back to that in a second, but this is a very beneficial, critical deduction for clients. Well, what it does was OB3, or what bonus depreciation does, is it allows oil and gas firms to immediately deduct the full cost of eligible capital investments, including drilling equipment, machinery, and infrastructure that otherwise would have been amortized. So what's nice about this is that going forward, you are able to deduct that right out of the gate, right when you spend it. However, and I mentioned the caveat, unfortunately, there was that little bit of a phase out that began in 2024, which reduced it to 60% available for bonus depreciation, the rest having to be amortized. If you made an investment between January 1st, 2024 and January 19th, 2025, it is eligible only for that 60% bonus depreciation. Um, and Congress, when we asked them why that date was, they said, well, that's what the White House wanted. They wanted only investments that were eligible since Trump took office to essentially be eligible for the 100% bonus depreciation. So it's a win, but not a full win. And then finally on interest deduction, again, this is just a recapture and making permanent something that the Tax Cut and Jobs Act did in 2017. It allows the add back of depletion, depreciation, and amortization to the adjusted taxable income calculation, effectively allowing deductions of up to 30% of earnings before interest, tax, depreciation, and amortization. And again, this made it permanent. And those are really a quick rundown of some of the critical provisions that were included on the taxing side of things, the ways and means side of things. And so, if you do have questions, let John know. But that was a quick run through of those. Let's jump into some of the more fun things. Again, I'm a natural resources guy. One of the critical things here that it did was it defunded the methane emission and waste reduction incentive program until 2034. Now, that's a long way of saying what industry has begun to call the methane tax. And so what the methane tax would have done, again, this was another provision that was adopted by the Inflation Reduction Act. It would have prescribed a fee on oil and gas facilities that report emissions greater than 25,000 metric tons of CO2 annually. And for every ton above that amount, it would have been $900 in 2024, $1,200 in 25, increasing to $1,500 in 2026 and beyond. This put that program on pause until 2034. And so while it's not a complete win, it's at least a hard punt, at least until that date. Secondly, for federal lands, it reinstated the 12.5% federal royalty rate for onshore leases. So again, under the IRA, they increased that to 16 2/3. This provision, and as I read it, and as my conversation with the congressional offices have read it, essentially negated that and said, we're going to go back in time as if this had never been enacted. And so if at some point in time since the passage of the IRA, companies producing on federal lands had been paying at that higher rate, I think you have a pretty strong argument to get a refund from the government at that 12.5% federal royalty rate. Again, alongside these federal lands, it reinstated non-competitive leasing and mandatory quarterly lease sales, of which Utah is specifically included. So they directed the Department of Interior, specifically the Bureau of Land Management, to hold those quarterly lease sales at least, well, obviously they're quarterly, at least 4 times a year, with Utah being called out. And finally, it struck the federal royalty on all extracted methane, which again was another fee that was imposed by the Inflation Reduction Act, saying that federal royalty would now be assessed on all methane that's produced, even that which is flared, vented, or due to negligent releases. So proceeding on from there, that's kind of a summary of what happened in back on July 4th when this bill was signed. So where are we at today? Well, there is on that greenhouse gas reporting issue. So the EPA has proposed a new rule, and I believe they had comments back. They were due either a few weeks ago or whatnot. But essentially, what this does is it removes program obligations for most source categories. So essentially, it says you don't have to report these greenhouse gases that you otherwise would have been had to report for the past. Now, I want to be careful about this because it creates an interesting conflict between certain mechanisms that do rely on this reporting function and other issues, right? So, for instance, the 45Q tax credit, that entire paradigm is built upon this greenhouse gas reporting mechanism. And if that is no longer there, there really isn't an opportunity for you to obtain that 45Q credit. So I don't know where the administration is going to end out on this. Obviously, the 45Q credit was just improved in advance by Congress. So I don't know if it's going to be voluntary reporting or whatnot, but there's going to have to be some sort of wiggle room that occurs to allow for people to take advantage of this if these reporting requirements do go away as proposed. Another kind of exciting area that I expect there to be some tax development on is the beneficial usage for natural gas that would otherwise be vented or flared, right? And so there's been some proposals out there, one of which was it's a mouthful, the Facilitate Lower Atmospheric Released Emissions Act by Senator Cruz, which would have sought to make permanent the 100% bonus depreciation for equipment used to intake natural gas and then transform it into electricity for beneficial on-site usage. I don't think that bill is really relevant anymore given OB3's 100% bonus depreciation provisions, but it sets an interesting conversation risk to go forward. Are there credits, are there incentives out there that we could use to promote the development of, let's say, data centers on some of these natural gas sites? I think this is a huge opportunity and would tie us at the hip with obviously this new massive growing industry with AI, et cetera, particularly as that new sector of our economy is draining the grid, et cetera. So I think there's a lot of opportunities for us to find natural allies out there and to take advantage of this gas that, essentially is being wasted. On the Department of Interior, and I'm going to apologize right here, I'm going to get into a little bit of the weeds here just because these are two items that I continue to work on a regular basis. But first, I want to point to this Expedited Appeals Review Act. This is a bill that we've worked with Representative Hageman out of Wyoming on. And it's amazing for a couple of reasons. One, what it does, which I'm going to get into, but two, it's already passed the House, and it passed the House on suspension. In other words, there was not a single Democrat that voted against this. This is a bill that has bipartisan support, hasn't had any no votes, and I think represents a real opportunity for producers who are stuck or who have to work on federal lands. So what this does is it goes after this obscure entity within the Department of Interior called the Interior Board of Land Appeals. And what they do is they oversee appeals of agency actions, specifically the Bureau of Land Management, the offshore entities like the Bureau of Offshore Energy Management, the Office of Natural Resources Revenue, so all federal royalty matters go before this, as well as some mining issues. The problem is they are not statutorily created. They are this pseudo-judicial regulatory construct that doesn't have timelines for most of their actions. And so if you are challenging a BLM leasing decision, rights of way decision, any other host of items, you have to go and sit for years. And in fact, they currently have over 650 pending appeals before them. Meanwhile, you're wasting attorney's fees. That's capital you can't deploy because sometimes you have to bond on these issues. And so you're stuck. What this bill does is it essentially allows you to have a ripcord to get out of this kangaroo court. And if you pull this ripcord and the department fails to act in time, when you go to district court, they do not receive deference. There is no arbitrary and capricious review anymore. Instead, it says we're going to consider the producer's arguments along against the department as if they're equal. So you'll be able to present your facts, you'll be able to present your arguments, and the department doesn't have that deference standard which they've used in the past to essentially bludgeon and define how they're going to regulate producers. On the second one, and again, this one's going to be a bit in the weeds, but as I mentioned, Ryan assists oil and gas companies to calculate federal royalties. There's two components to the calculation of federal royalties: your transportation allowances and your processing allowances. For Utah, the latter, processing allowances, is a critical issue in ensuring that you're not overpaying what you otherwise would be owed. But back in 2015, under the Office of Natural Resources Revenue decided to adopt a new interpretation of its regulations. This reinterpretation was called unbundling. And if you haven't ever had to deal with that, good for you. But if you have, it's a nightmare. Essentially, the government said, you can try to calculate this, which is impossible. You can use our deductions, which are unfavorable, or you just can't deduct anything. But the reality is that's an unfair kind of conclusion. So historically, producers were required to place a product in a saleable condition, meaning in a condition that would be accepted at the processing plant, right? So that's typically where it would. The department has expanded that to say, okay, well, we have nebulous guidance within our regulations. It says field or area, and area is essentially whatever we define it to. So Honor has utilized that broad term area to require producers now to bear the costs associated with placing the gas in a condition that is near consumer grade, potentially hundreds of miles away from where it was produced, essentially negating the processing allowances that would otherwise be allowed for much of the onshore production. So these are two items that we're going to continue to work on. I'm hopeful about the Expedited Appeals Review Act. Federal royalty, when it comes to oil and gas, it's tough to get both sides of the aisle there, but we'll continue to press that. So where do we look going forward? Legislative opportunities are looking a little grim, right? There's conflict between the parties, and we're currently in a shutdown. Now, the big question of the day is, when is the shutdown going to end? And I'm going to answer it the same way I have for the past 4 weeks, which is next week. Obviously, I have been wrong the past 4 weeks, but I do think that the boiling water is starting to reach the edge of the pot with the ending of SNAP benefits this upcoming Saturday, with air traffic controllers starting to have issues. So I think that there is going to be an opportunity to end it. But even if they pass the bill, it's only through November 21st. So they're going to have to do some work really quickly. The other two opportunities for legislation: one, there's discussion of bipartisan tax bills. Both the Senate and House relevant committees, the majority and minority, are in discussions. A lot of this is going to be focused on IRS procedure and whatnot, but I do think that there might be some opportunities to discuss either credit extensions, et cetera. So we'll see how that plays out, but it's talks haven't ended. So I'll just put it that way. And then finally, the further reconciliation bills, right? So are there going to be opportunities to impose legislation that has budgetary consequences but would be beneficial for the oil and gas industry? Speaker Johnson had said that he had wanted to see three, OB3 being the first of the trio. I don't see a second one possibly happening. And a third one, while everyone would like to see one happen, in another bill, it's really going to depend on if Congress can define what that budget number is. Are we going to increase the deficit, decrease the deficit? And so those are big questions. And as I said today, I would say low chance, but let's not give up hope just yet. So that's kind of a quick run through of all the federal items that we're working on. Not all of them, but some things that we're working on that are impactful to Utah producers. But let's get quickly into state issues. And I think the big question that we have is, how does Utah compare to other states? And so obviously I'm a federal guy, but I reached out to some of our subject matter experts to get a little bit of context into this, right? And on severance taxes, I have to admit, my subject matter expert said, from a deduction standpoint, Utah is frankly one of the best and most industry-friendly states. The transportation deduction in Utah applies to both oil and gas, whereas in other states, it's either gas or oil. For instance, in North Dakota, it's just oil. In Texas, you can only take marketing cost deductions for your gas produced. So that allows Utah a real great opportunity to say, hey, look, we are doing something positive. This is why you should produce here. The one criticism, though, that we would have with this is, like how federal royalties are calculated, Utah does impose a 50% cap on the transportation deduction. So it can't exceed 50% of the value of the product that's being transported. Now, this is really impactful when you're in a low commodity value situation, right? So natural gas, you're going to be hitting that cap rather quickly. And so that it might be an opportunity where Utah could improve and to allow a little bit more flexibility. On the on the incentive side of things, Utah again is fairly competitive. They offer both the stripper well exemption and a new well exemption. Stripper wells have a 12-month exemption from severance taxes, whereas new wells are exempt from paying severance taxes for the 6 months of production. But the new well exemption, if you compare it to other states, could use a potential, there is some ground for improvement. In Texas, and again, this is just for gas, there's a thing called the high cost gas incentive. It's a 10-year incentive, which is based upon the total value of the drilling and completion costs. The higher those costs go up, the lower you're paying. Almost in some circumstances, your high cost gas incentive could reduce your severance tax owed to 0%. And then in Louisiana, for instance, they have horizontal and deep well exemptions, which again exempt you from having to pay severance taxes, where it exempts essentially it's either the earlier of 2 years or until well payout. So that 6 months for new wells is a little bit on the short side, but again, overall, as severance taxes compare across the states, Utah is rather favorable. Now we get into the sales and use taxes, and I think this is where we could use industry could certainly use a little bit of leeway. Unlike other states, and I'll get into Wyoming in a second, Utah does not exempt a lot, if anything, of the equipment that you're using to frack or to develop a well site, et cetera. I know there's some electricity exemptions associated with that, but overall, oil and gas is carved out of the mining exemptions as a whole. Wyoming, by comparison, does not tax fracking equipment. It doesn't tax certain pipelines. It doesn't tax other instances. And so I do think that there's a pretty good opportunity for Utah to look at some of those Mountain West states like Wyoming, like North Dakota, to say, okay, what are they doing on this front? And how could we be better incentivizing our oil and gas producers through these manufacturing and mining exemptions that are found elsewhere? The other thing, so those cover really the big, broad things. The other two items that I wanted to flag here for the local impact mitigation tax, I know that's a new tax that's going into effect on January 1st. This is similar to items that are found in California and Texas. We are starting to look at that to see how it's going to impact our clients. And so as that's a development, as that's something that's newly being impacted, we're probably going to take our experience in Texas and see how that will inform our advice that we're providing to the clients on this front. And then second, and the high cost infrastructure tax credit. This is an area that we are super interested in. We already have several clients signed up on this. I know Holland and Hart gave a presentation on this a month ago to you guys. And so, this is something that we want to continue to work with the industry in Utah on. And we would be happy to help calculate this and obtain this credit for you. So that was a quick rundown of federal, state tax issues that are impactful for Utah producers. Gonna just quickly hop into questions, comments, concerns, criticisms, one way or the other. Happy to answer, happy to receive any.
So, Andrew, I'm curious. I'm interested in you going back to the federal side because we had a question from Cody Stewart. And I may phrase this slightly differently than he did, but it said, given all that's going on or not in DC, do you have any hope that there will be any additional substantive legislative changes to oil and gas policy? Or do you think what we have now is what we will have? So I suppose the question I have for you is, what is the likelihood of some of the things that you talked about actually coming to fruition?
It's a fair question. And first off, shout out to Cody Stewart, who was a former boss of mine. He's a great guy. I appreciate the question, Cody. But from my perspective, it's going to depend, right? When I talked about that federal royalty thing, which is a very monetary driven item that benefits oil and gas, I would say issues like that, if we're going to have a reconciliation bill, it's completely contingent on that. So putting that at less than 10% just because I don't know if the reconciliation bill process is going to happen again. But for the broader issues, right, things where there are bipartisan discussions occurring, I think there is a greater opportunity. And I do think that we're going to see some legislation come through either in an omnibus package at the end of next year, maybe something at the end of this year, although I don't know what with the shutdown how that's impacting it. But I know ongoing conversations are going, there's continuing to have permitting conversations as a whole. My lobbyists are telling me that those conversations, despite the dour attitude and sour attitude that is in DC, there's still real discussions and real opportunities here for something along those lines. So it's a mixed bag. I do think that Congress can't just not do anything because there are going to be other tax credits expiring at the end of this year, next year, et cetera. And so I do think that there's going to be pressure points from constituents affecting both sides of the aisle equally that they're going to want to see some movement. So, I mean, I'm optimistic. I would say greater than 70% to see a bipartisan piece. I don't know how impactful it's going to be for oil and gas, just because oil and gas, had that IRA hangover impacting it. But I wouldn't discount it as a complete an opportunity, right? It's certainly in the permitting space. We're not going to go and build a bunch of new solar and gas fields without something happening for oil and gas.
Yeah, understood. Um, Sticking with that crystal ball theme just a little bit, traditionally in presidential administrations, the midterm elections see a pendulum swing to the other side. And let's say that does happen in 2026. Are you hearing anything from your lobbyists or, perhaps those who are working on the Democratic side? Do they have their eyes on anything in the oil and gas field that our members should be aware of? And how likely do you think that is going to be enacted, given that there's some potential gridlock there?
That the former question is what we're hearing on what the Democrat side, if they were to retake the majority. Um, I haven't heard anything specifically from either my lobbyists or others, and the reason being is I think most are still focused. Everyone's still focused on what can we get done in this last year that we have the majority, right? That's really the focus, and that's going to continue to be the focus. With the Trump administration, I don't think they could do much, right? That's not going to change, and so maybe it would be essentially deflecting, grazing blows, but I don't see any substantial negative impact occurring, at least in that were that Congress to flip. As for the question of whether that's going to happen or not, I think it's really going to depend on these midterm, not the midterm, obviously it's going to depend on the midterms, but the redistricting battles, right? How is that going to turn out? Is Indiana going to redistrict? Is New York going to redistrict? Is California, right? Texas here, we've already done that. I think it's still a ballot initiative, but it's expected to pass. And so with those kind of conversations ongoing, how does that look? How is that going to negate it? I think that's really where it's going to turn out to be. So, I mean, Texas, we added, I think, potentially 5 new Republican seats, with hoping, as it turns out, that the elections reflect the 2024. So we'll see. But that's really what the big question is how do these redistricting fights turn out over the next few months?
Sure. You advise clients all across the country, and many of them with a lot of federal issues. Given what we saw in the reduction in federal workforce earlier in this year with things like DOGE, what has the impacts been to them for clients that you deal with? How does that impact the work that they have to do in the tax space? Can you speak to potentially impacts to the federal workforce and how that has gone downstream to clients and how they interact with the federal government?
Yeah, I think I can, at least on the tax space and whatnot. Um, you know, it's a really good question because I don't think there's been a very comprehensive capture of what has transpired since the beginning of this administration. And I've heard through either former employees themselves that, for instance, the Office of Natural Resources Revenue has lost about 25 to 50% of its workforce. So that's auditors, those are people that are calculating, looking at the royalties. And so with that transition, though, the what I've seen actually happen with our clients is less of a focus on the auditing side of thing and more of a focus on, okay, well, what is how are these calculations being run, et cetera, trying to provide lower level, not guidance necessarily, but at least more of it's taking a step back and not so specific on the issue. So I would say the rifts have been somewhat beneficial on that front. But for others, you look at some of our IRS clients and it's just been black box, right? We don't know what's going on with a lot of the claims. we can't get any information. Websites are down, they don't work. The calls, you can call the IRS hotline and it's going to take you 3 hours before you get someone who doesn't know anything. And so it's a real problem that we're seeing across the board. It just depends. It's a mixed bag. And so I don't know how we get out of that, right? I just the other day, the Trump administration let go the whole community development fund team at Treasury, and we saw a substantial pushback led by Senator Hatch, the chairman of the Senate Finance Committee, against this. So I do think that with some of these rifts, there's going to be pushback from Congress. There's going to be this, and so I don't know how long term this is going to play out. Also, there's court cases that are going on, but it is impacting our clients to a certain extent, and we'll just have to see how it plays out, I think.
I think this is a landscape unlike one we have ever pretty much seen. And I know that businesses, when they're looking ahead, they thrive on certainty. And what we're getting is a lot of uncertainty coming at the federal level. So my question to you is, in terms of planning your business, in terms of being prudent, and you have a fiduciary responsibility, this is the way that you need to govern your company. What would be the advice that you have in terms of seeking certainty in a very uncertain kind of milieu?
Oh, it's a good question, right? You have the tariffs coming in, you have a whole host of other items, and then you've got litigation surrounding all of this.
And it seems to change very, very frequently, right? Where the seas are not very settled in one direction or another. Where one thing is true one day, it is not true the next day. So how do you sort of steady yourself in an environment like this?
Yeah, I'm trying how best to think in response to this.
I like to give you the easy ones, Andrew. That's why we have you here.
Exactly. And and I don't want to sound like I'm being self-serving here, but this is really where it helps to have people like Ryan there that are looking at this, right? We have a team that's dedicated to tariffs. We have a team that's dedicated to ongoing regulation changes, et cetera, and examining this. And I do think that if you're a company that is tasked with doing this on your own, you don't know which way the wind is going to be blowing tomorrow, as you correctly alluded to, John. And so I do think that's why you have to come to rely on people and on groups that at least have some of a broader sense of what's going on rather than just you. And I think that's the critical component, right? It's when you are watching this and standing alone, it seems like the world's against you. But when we come in, we have a broad base of oil and gas clients, and we can look at this and say, okay, well, here's what's going on in this sector. Is this across across all client base, or is this a unique instance? And I think by having that kind of level setting, it's just saying, okay, how do we address it if it is a unique one? But this is what's going on. How can we plan for future changes, because this is an impactful thing that's going across the industry as a whole. And so I would say, reach out to your colleagues, see how they're addressing it, make sure it's not just a unique issue, because again, that's really going to determine it too.
Yeah. Yeah. I think that's probably about as prudent as you can be. And a follow-up question, and this might be far outside your scope, so feel free to punt on this one. I'm going to give you that out right away. But some of our majors do have, or some of our members are majors who have operations internationally. Are there any lessons that we can draw from work in other countries in this space, or lessons learned, or things that have been tried that can be applied to the U.S., things we should look out for, things that we should understand? Anything in the international space that informs what we can expect here domestically?
On that specific question, I can't answer that with certainty. Now, what I will say on that former point, though, and I'm going to go back to my time on natural resources. We did make some trips out to countries like Australia, right? What are they doing on their permitting process? How does it look compared to ours? What is the litigation points that they see versus our points? How can we model and mold our legislation to more impact, take the goods that they have and leave the bads? And so I do think that there's a lot of opportunity specifically in the Australia offshore space and other countries that represent, how we can model that. I can't speak with certainty about how we can react to what's going on here, but there's a lot of there's a lot of investment that's going on offshore, like Guyana, et cetera. And so I think we're going to continue to see that. I don't think we need to be turning to those other countries for regulatory advice, probably, because I do think that America, at the end of the day, is one of our big talking points is we produce it the best and it's the cleanest and all of that. So, but efficiencies are always something that we look for. And that's one thing that, again, as I do on my daily basis. All right, well, Texas does it this way. Could the federal government be adopting a similar tactic when they're looking at this? And so those constant comparisons across the board, yeah, we're happy to do that.
A company like yours certainly has its eye on any number of things in any number of directions here. So that's what I hear you saying.
Yeah.
Yeah, 100%. Okay. Not seeing any questions in the YouTube chat. I think what we'll do is we're going to shut this down just 10 minutes early. But Andrew, this was really comprehensive. This gave us a great lay of the land. There are certain things, obviously, that we cannot know, that we cannot predict, but we stay vigilant. That's why we have this Lunch and Learn series. That's why we invite companies like Ryan to share their expertise. And this, along with all of our Lunch and Learns, will be available on our website coming up very, very soon. That's on utahpetroleum.org. You can look at the Lunch and Learn tab. You can see the ones that we've had in the past. You can also see the one coming up next week, next month, where we're talking about safety. And until then, please note that we have our annual meeting coming up in March. Get yourselves registered for that. More information on that coming very, very soon. And you note that Ricky said we have a very simplified process in terms of how you want to be involved with UPA in the years ahead. So 2026, one check will go to everything you want to sponsor. Very exciting. You can see on screen Andrew Vacera's contact information. That is the Utah Petroleum Association information. I've got, we'll have this available for you if you'd like a copy of this PowerPoint. We will provide it for you. There is Andrew's contact information, his email, and his phone number. But thank you very much for joining us. And we wish you a good day. We'll see you back here next month. Andrew, thanks for your time. Thanks for your expertise. And thank you all for joining us.
Bye.